Welcome to Sophie Daddy's channel. Today, we're going to demystify a term that's thrown around all the time, one that's just packed with drama and mystery: insider trading.
So let me ask you, when you hear that phrase, what's the first thing that pops into your head?
For most of us, it's probably something like this: crime, big scandals, maybe even prison. We think of these shady backroom deals, whispered tips, and executives walking away with millions right before their company totally collapses. And you know what? You wouldn't be wrong some of the time.
But here's the twist. What if I told you that most insider trading happens every single day, right out in the open, and it is 100% legal? Yup, that same term covers both a serious federal crime and a totally routine, regulated market activity that happens constantly.
Okay, so let's dive into that. We're going to separate the Hollywood fiction from the facts. The line between a normal stock purchase and a felony is actually surprisingly clear, and it all boils down to one single concept.
And this is it, material non-public information, or as it's known, MNPI. Just think of it as a really important secret. It could be anything, like an unannounced merger, a terrible earnings report that's about to drop, or even a huge new product breakthrough. Basically, if it's something that could move the stock price, and the public doesn't know about it yet, that's MNPI. This really lays it all out, doesn't it? It shows the two different worlds of insider trading. Over on the left, you've got the legal stuff, an executive who is trading in the open using the same public information as everyone else. But on the right, that's the illegal side, all cloaked in secrecy, all driven by that unfair advantage you get from MNPI. And what's so interesting here is how this breaks down those core differences. A legal trade, it's disclosed, it's transparent. An illegal trade is all about being hidden, and the intent is really the key. Legal trading is about managing your own finances. Illegal trading is all about exploiting an advantage nobody else has. So to make sure everything is transparent, the SEC requires insiders to publicly report their legal trades. This is done through a system of forms, and the most important one for us, really, is Form 4. Because of the Sarbanes-Oxley Act, an insider has to file a Form 4 within just 2 business days of making a trade. This gives the public a near real-time look at what they're doing.
Okay, so if all this data is public, can we actually use it? Can we follow the smart money? Well, a lot of the world's most successful investors would say, absolutely.
The legendary investor Peter Lynch just summed it up perfectly. What he's pointing out is this incredibly powerful imbalance. Selling, well, that's ambiguous. An insider could be selling to diversify their portfolio, buy a house, or pay a big tax bill. But buying with their own money on the open market, that is a pure, powerful signal of confidence.
So, let's see how we can spot a really strong signal. First, you want to ignore things like routine option exercises and just focus on open market purchases. Second, you look for cluster buys. This is when multiple insiders at the same company start buying around the same time. That suggests they all believe the stock is a bargain. And finally, the strongest signal of all is a contrarian move, when insiders are buying like crazy while the rest of the market is down on their stock.
And hey, this isn't just a hunch. Academic research actually backs this up. Studies have shown that portfolios that mimic these high-conviction buys, so large, clustered, or contrarian purchases, can generate some pretty significant returns, sometimes over 20% in the next year. But on the flip side, just like Peter Lynch said, selling is a much noisier signal. An executive might be selling just to diversify their wealth so they're not all in on one company, or to cover a massive tax bill, or maybe to pay for a big life event. So acting on a single sale without looking at the bigger picture is usually a mistake. But what happens when insiders cross that very bright line, when they go from using public signals to exploiting secret information? Well, that's when things get ugly. Let's look at 3 cases that literally changed the law. The Martha Stewart case is a classic. Now, she wasn't an insider at the drug company ImClone, but her broker tipped her off that the CEO was dumping his stock right before some bad news from the FDA was about to hit. So she sold and avoided a loss. But the real crime, the one that got her, came later. She and her broker made up a cover story, a fake stop-loss order. And that lie is what sent her to prison, not for insider trading, but for obstruction of justice. The cover-up was literally worse than the crime. Now, a way more complex case was the one with hedge fund billionaire Raj Ratnam. This wasn't just a single tip. This was like an industrial-scale operation. He built this huge network of paid informants inside major companies. We're talking Goldman Sachs, McKinsey, who are constantly feeding him confidential information. This case was a game changer because for the first time, investigators used wiretaps, just like in an organized crime bust, to get the absolute smoking gun evidence.
And then there was Enron. This showed the absolute darkest side, where insider selling was just the final act of a massive corporate fraud. While the executives were publicly telling employees to buy stock for their retirement funds, they were privately dumping hundreds of millions of dollars of their own shares because they knew the company was a complete house of cards built on accounting lies. The collapse just wiped out thousands of jobs and pensions, and it led directly to that Sarbanes-Oxley Act we talked about, which completely reshaped corporate rules.
So these cautionary tales really show why regulation is so important. But for you, as an investor today, how can you actually apply this knowledge about legal insider trading without getting into trouble?
Okay, here's the most important takeaway. Insider data is a really powerful tool, but it should be just one tool in your whole toolkit. Think of it as a starting point for more research, not just a clear buy or sell signal all by itself. The real edge comes when you combine these insider signals with your own analysis of the company's health, its value, and what's going on in the wider market.
At the end of the day, understanding these signals gives you a pretty unique peek into what the most informed people out there are thinking. But this whole thing is always changing, which leaves us with a really fascinating question. As regulators work to build these higher and higher walls to stop illegal trading, are insiders just finding cleverer and cleverer ladders to get over them? It really is a constant cat and mouse game, and it continues to shape the very fabric of our financial markets. Thanks so much for watching.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.